India's economy is facing headwinds. Growth has slowed in recent quarters, consumer sentiment is weakening, businesses are holding back on investments. The government is under pressure to take action. Prime Minister Narendra Modi is facing criticism for his handling of the economy. His government has announced a series of measures aimed at boosting growth. These include tax cuts and interest rate reductions. However, investors remain unconvinced. They are concerned about the effectiveness of these measures. They are also worried about the broader economic challenges facing India. The slowdown in India's economy is a cause for concern. The country has been one of the world's fastest-growing major economies in recent years. However, growth has slowed in recent quarters. This is due to a number of factors including weak global demand, the US-China trade war, and domestic policy uncertainty. The slowdown has had a negative impact on businesses and consumers. Businesses are investing less and hiring fewer workers. Consumers are spending less, leading to a decline in demand. The government has announced a series of measures aimed at boosting growth. These include tax cuts for businesses and individuals, as well as increased infrastructure spending. The Reserve Bank of India, the country's central bank, has also cut interest rates to make it cheaper for businesses to borrow money. However, these measures have so far failed to revive the economy. Growth remains sluggish and investors are still hesitant to invest in India. There are a number of reasons for this. First, the global economic outlook remains uncertain. The US-China trade war is still ongoing and there are concerns about a slowdown in the global economy. This has made investors risk-averse, and they are reluctant to invest in emerging markets like India. Second, there are concerns about the effectiveness of the government's stimulus measures. Some analysts argue that the tax cuts are too small to have a significant impact on the economy. Others argue that the government should have focused on structural reforms instead of short-term stimulus measures. In an attempt to revive the flagging economy, Prime Minister Modi's government has unveiled a series of stimulus measures. These measures are primarily focused on two key areas: tax cuts and interest rate reductions. The goal is to encourage spending and investment, thereby boosting economic activity. The tax cuts, totaling 1 trillion rupees, represent a significant reduction in the tax burden on businesses and individuals. This move is intended to increase disposable income and encourage consumer spending. The Reserve Bank of India, in coordination with the government's fiscal measures, has taken steps to ease monetary policy. The central bank has reduced the key interest rate by 25 basis points, marking the first such cut in 5 years. This reduction in borrowing costs is aimed at encouraging businesses to take out loans and invest in expansion. The RBI's move is also expected to make loans more accessible to individuals, potentially boosting consumption. The combined effect of the government's tax cuts and the RBI's interest rate reduction is intended to create a more favorable environment for economic growth. By putting more money in the hands of consumers and businesses, the government hopes to stimulate demand and investment. The success of these measures, however, depends on a variety of factors, including global economic conditions and investor confidence. Despite the government's efforts, investors remain unconvinced about the effectiveness of the stimulus package. Some analysts argue that the tax cuts are insufficient to offset the negative impact of the global economic slowdown. Others point out that the RBI's interest rate cut, while a step in the right direction, might not be enough to spur significant investment in the current climate of uncertainty. The effectiveness of the stimulus measures remains a subject of debate among economists and market analysts. Despite the Indian government's efforts to stimulate the economy, investors are not convinced. The stock market has reacted negatively to the announced measures, with key indices showing a downward trend. This skepticism stems from a number of factors that raise concerns about the effectiveness of the stimulus package and the overall economic outlook. One major concern is the limited impact of the tax cuts. With a significant portion of the Indian population not liable for income tax, the benefits of these cuts are likely to be limited in scope. Investors are also worried about the government's ability to finance the tax cuts without jeopardizing fiscal discipline. There are concerns that the government may resort to borrowing from the RBI, which could potentially fuel inflation. The RBI's neutral stance, despite the rate cut, further adds to investor uncertainty. The central bank has not signaled any further rate cuts, and there are no new liquidity measures such as a cut in the cash reserve ratio or bond buybacks, which would inject more money into the system. Adding to the uncertainty is the simultaneous announcement of a massive stimulus package by China. While the effectiveness of China's stimulus is also debated, its sheer size has the potential to draw investor attention away from India. Investors may perceive China's stimulus as a more attractive opportunity, given its scale and potential impact on global demand. The lack of investor confidence highlights the challenges faced by the Indian government in reviving the economy. The government's measures, while well-intentioned, are seen as insufficient to address the deep-rooted structural issues and the uncertainties stemming from the global economic slowdown. Investors are looking for more concrete signs of recovery and decisive policy action before committing significant capital to the Indian market. India's economic future hangs in the balance, facing a confluence of internal and external challenges. While the government grapples with stimulating growth, global uncertainties cast a long shadow on the country's economic prospects. The ongoing trade war between the United States and China, coupled with a potential global economic slowdown, has created an environment of risk aversion among investors, making them wary of emerging markets like India. This external pressure further complicates India's efforts to attract foreign investment and boost exports. Domestically, India faces a multitude of economic challenges. Weak consumer sentiment, declining corporate profits, and a slump in manufacturing activity all point towards a deeper slowdown. The agricultural sector, a significant contributor to India's GDP and employment, is also grappling with low crop prices and farmer distress. These internal issues further dampen investor confidence and hinder the effectiveness of the government's stimulus measures. Expert opinions on India's economic outlook remain divided. While some economists, like those at Nomura, project further rate cuts by the RBI due to the continued economic slowdown, others, like Chief Economic Advisor V. Anantha Nageswaran, remain optimistic about India's long-term growth potential. The RBI Governor, Sanjay Malhotra, projects a 6.7% growth rate in the coming fiscal year, aspiring for a 7% long-term growth trajectory. However, Standard Chartered economists believe that while the government's actions could set a floor for growth, the economy remains vulnerable to further weakening. The road ahead for India's economy is fraught with challenges. The effectiveness of the government's stimulus measures remains uncertain, and the global economic climate continues to pose significant risks. Addressing deep-rooted structural issues, boosting domestic demand, and restoring investor confidence are crucial for India to navigate these turbulent times and achieve sustainable economic growth.